right, welcome to another great money talk. Happy Tuesday, everybody. It's another great day to be alive, another great day to do something incredible, another great day to learn. As your educator and host today, my name is Keon Corniff, also known as Mr. Finance, and I'm extremely happy to educate you and tell you all about the great things about finance today. So, as you know, today's topic, our topic for today, we're talking about part two about life insurance, right? That's what we are on the topic of today about life insurance. And not only just talking about life insurance, but also we're talking about the different kind of life insurance, right? Different kind of life insurance. What are the different types out there and how they work? So let's jump into it, right? So that way we can get it done. And that way we can open up for some Q&As. So first thing first, in order to understand life insurance, you got to understand there is pretty much two kind of life insurance, right? No matter what nobody tells you, no matter what nobody say, no matter what you may hear, there's only two kind of life insurance out there. There's either a permanent life insurance or a term insurance. Once again, there's temporary insurance, permanent life insurance. Temporary insurance, permanent life insurance. All right. But all insurance, I'm going to say something that could be controversy or could be misunderstanding, but all insurance are term. All right. All insurance are term insurance. And you're probably wondering what I mean by this. It's because each of them has a term. Some of them is a 5-year term, 10-year term, 30-year term, 100-year term, 120-year term, right? These are different kind of terms. So these life insurance have many kind of term insurance, but some of them is considered to be temporary and some are considered to be permanent. Permanent means they give you a longer term. Temporary means they give you a shorter term. This is life insurance, guys. So to let's start about what are the different kind of temporary insurance out there. And some of the temporary insurance that you may know of, things like term life insurance, right? And term come in different forms. They have what's called as a ART term. So if you remember the acronym ART term, which means for annual renewable term, where you renew the annual either every year, or you can do it every 5 year, or you can do it every 10-year, 20-year, or even 30-year. So these are called annual renewable term. Now you also have what's known as an increase in term or a decrease in term. Most people use increase in term to have the term death benefit goes up every year, but that comes with a higher cost. There's also people that buy decrease in term, also known as mortgage insurance, where the term it decreases as the balance of your mortgage decreases, right? And sometimes it's even cheaper to get even a level term versus a decreasing term, because why have it decrease when you could just have your mortgage decrease but keep the same amount of coverage if you're going to do it that way to protect the mortgage. Another thing too, they have what's called a return of premium. A return of premium, all right, ROP term. They have those terms as well. And these are the terms that you also can own, and these come with a hefty price tag, right? But at the end of the day, let's say that you have contributed $20,000 over a 20-year period in your term policy. You would then, at the end of that 20-year of the term, you will receive back what you have put in. But just keep in mind that these things also come with tax disadvantages, that you may be subject to some tax responsibilities, okay, at the end of that term as well, because now that money is considered to be taxable. All right. So these are things that we got to know when it comes down to term, right? And one of the other things I want to talk about also is what are some of the different kind of permanent life insurance, right? Permanent life insurance. What are different types? Because most people think that the only permanent insurance, I tell you, when people look at me and say, Keon, I want a permanent life insurance, and they always go to the word whole life, right? Because that's what most people only know. Most people only know of whole life to be a permanent insurance, but it's not the only permanent insurance out there. Did you know that? right? So this is what you have to know. So there's many kinds, right? Many types of permanent life insurance. There are things like a whole life. There are things like a universal life. There are things like index universal life. There's also things called um, it's coming to me. Oh, a VUL, verbal universal life, right? These are all different kind of permanent life insurance, right? They have a much longer term that they could give you to lock in on. So when you look at like a whole life, what's the difference between a whole life and everybody else? Well, a whole life is known to be a very fixed product. And what I mean by being a fixed product, it means that you have a fixed monthly premium, you have a fixed face amount, right? And if you miss a payment, you have what's called a 30-day lapse period. All right. So these are fixed products. They're very fixed. There's no flexibility inside of them. If it's $100 a month, they expect you to pay $100 a month, and they expect you to contribute to it. That's why it's called your whole life, because you may have to contribute to it for your whole life, right? Or the certain period of time. Because some of the things about a whole life is that also it gives you little interest that you could earn on that money. Little interest, not a lot of interest you could earn inside of it. So the cash value doesn't grow as quickly. They have even what's known as a large loan charge for when you want to take out the money through a tax-free loan. It actually comes with a very large interest on that loan charge as well. The thing about whole life as well is that, it's very old. It's very old. It's like comparing an iPhone to a Nokia, right? So yes, it's one of the first original forms of permanent life insurance, but it's very outdated, and life insurance have changed and evolved over the years, and it's done some amazing things over the years. So it's definitely important. If you got a whole life, you definitely want to look into other things and learn about other products as well, and see if you can upgrade and do better, right? The one thing that most people say about whole life is that they guarantee you a certain interest a year, which is very conservative. It's a very conservative guaranteed interest, anywhere in the 2%, 3% range, that they guarantee you every year, no matter if the market does good or bad. But even though what they guarantee you, is it enough to keep up with inflation? So you got to keep all of these things in mind as well, right? And make sure that this is the best fit for you. Now, there's things called universal life. And universal life, it works very great because it's the difference between whole life and universal life is that universal life is very flexible. And it comes with a lot of flexibility, like within the premiums and the face amount, where you could pay more in your premium, or you could pay less. And you can even skip a few months payments if you have enough money built up in your cash value to pay for the cost of insurance. You also have the flexibility where you could change your face amount, all right, or your death benefit. You could change that as well. It's very flexible in that as well. And it gives you a lot more room. It gives you some really good, better rate of return. So universal life, it doesn't give you a high rate of return. It's very it's well over conservative. It's well over conservative for universal life. All right. So it's just that it has a great feature, which is the flexibility. Now, an index universal life, known as an IUL, it works very similar to a universal life, but it's the index that makes it extremely different. Now, the index gives you ability to where your money can get credited, not into the market, not in the stock market, but you get credited by the performance of the index. An index account like a S&P 500 or a NASDAQ or a Dow Jones or a Euro stocks, right? All of these things are different indexes that's in the market. So based upon the performance of the index, you would then get credited to your account, all right, where you have cash in your cash value account. Now, another thing that you got to also know is that in an index universal life, it gives you something called a cap, and it also gives you something called a floor. And with a cap and a floor, the cap determines how much interest can be earned inside of your policy. Some companies give you an earning potential of 15%, okay, where you can earn up to 15% in interest credited to your account. So if the market does 20%, you will only get 15. But if the market does 10%, you will get 10, right? So there's also something called a floor, which means that your money gives you a lot of things called safety, and a lot of companies guarantee this. I particularly know a company that actually gives you 0.75% positive every time when the market does a negative. All right. So imagine that. You want to know who these companies are. That's why we encourage you to definitely sit down with a person that invites you, so that way they could tell you more about that as well. So another thing you got to look at is the fact that even with such grace and, you know, incredible things that you could do when it comes to these vehicles, man, it's quite a beautiful thing. You know, it's a very beautiful thing to know that you can have growth and safety at the same time when it's pertaining to like an index universal life. Plus, it gives you the flexibility as a universal life. Now, as for something called a VUL, which is known as a variable universal life insurance, this is actually like the opposite of an IUL because of the V. The V stands for variable. Variable means that the money is in the market. So the money is directly inside of an index in the stock market. So if the market does good or bad, it is affected by the fluctuation of the market. But it still gives you that flexibility because it's still a universal life insurance, and it gives you where you can put in more premium or less, or even skip premiums if you have enough money in the cash value to pay for the cost of insurance. So that's the only difference between a VUL and an IUL, is that the VUL is directly in the market because it's a variable. The index universal life is not in the market, but it gets credited by the index performance. And it's important that you know this as well. Now, in regards to other type of life insurance, like let's talk about final expense insurance. The reason why many people never heard of a final expense insurance is because a final expense insurance is another type of whole life, but it's a cheaper version of whole life that gives you just little less coverage, right? Because it's really money that will be available to you within 48 hours of your passing. And it's important for you to know that this is also available to you, but it's very cheap. It is very, very cheap to have access to final expense insurance. And it's another form of whole life, right? And majority of the time, your final expense insurance will provide coverage up until age 100, all right? And it's good to know that as well. So when it comes down to determine what kind of life insurance would probably be best for you, you must understand that making these decisions is based upon, once again, your dime method about where you find out how much you need, and then it's based upon what is your budget, what can you afford, is it affordable and suitable for you, right? And that would determine if you need a term, because term is very cheap. Term insurance is very cheap, but like I said, the money that you put inside of it, you can never get it back. There's no cash value. It just simply you're buying insurance and hoping to die at the term that you committed. That's what it sounds like to me. It's not what it is, but I'm just saying, you know, it almost sounds like that's what you're saying, that, hey, I'm going to die 30 years from now, right? But if that's what you can get, that's what you afford, and that's what you can do. Now, as a whole life is permanent. Yes, it gives you coverage up until age 100. And it's not flexible, though. It's very fixed. So the premium is the premium every month, and the face amount is the face amount, and it's very fixed. There's no flexibility in there. It gives you a very conservative guaranteed interest every year, and the loan charges could be quite high sometimes. Now, as far as a universal life gives you a lot of flexibility where you could pay more or less, and you can even change the face amount if you need to. And like I said, the interest earning potential is very, very much better than a whole life, which is over a very conservative rate of return that you receive. And then an index universal life gives you the same flexibility as a universal life, but it gives you the index, where you could get a higher cap of earning potential and still give you a floor to never lose your money. And on top of that, it's credited by the index, so your money is never at risk inside of the market. And then you also have what's called a VUL, Variable Universal Life, and this is also another vehicle that your money is inside the stock market, and it's in the market inside of some form of index, and depends on how the market does. That's performance of your cash value. So if the market does well, you're going to have a lot of money in your cash value. But if your market does bad, you will lose money from your cash value, because the money is inside of the market. But it still gives you the flexibility, like a universal life, where you could pay more or less, depending on, you can even skip a few months payments if you have enough money in your cash value to pay for the cost of the insurance. And as you know, it gives you all the features of having life insurance. So what are some of the tax advantages that you receive owning life insurance? But before I get into that, I also want to touch on a little side note, right? We're going to talk about side notes now. So side note insurance, things like accidental insurance, also known as double anatomy coverage. And these type of insurance pretty much is for accident. Accidental insurance is for exactly what it says. Accident, meaning that if you die from a car crash, all right, if you dropped off the roof, if you slip and fall and die at your job, or any accident. It's literally just to cover accidents. If you die from an accident, and they say that you had a $500,000 coverage, yeah, and you then had a $500,000 accident coverage. So if you die from a car accident, okay, and they will pay out $1 million, because if your family will get the death benefit and the accidental coverage as well. So my thing is, most people don't die from accidents. All right. So to me, I honestly tell people, you don't really need an accidental insurance unless you plan, if you're a risk taker, you're going to die from an accident, and just be careful. Make sure you read their stipulations and rules upon what they pay out, because accidental insurance, they have a very, very strict review before they pay out, and their payouts are very minimum. They don't have a high payout rate, all right, because they always find some way to realize that you didn't die from the accident. You probably died from the impact of the accident that hit something else. It's very crazy, but make sure you do your due diligence and find out what are their stipulations with those products. Also, another side note, as far as the insurance final expense, like I said, it's another form of whole life. So it gives you, like I said, it's very cheap, and it gives you a little coverage though. So it's little coverage, enough to take care of the final expenses. And they even have plans that are even $20 a month, right? $20 a month, you can have final expense to make sure you take care of your funeral arrangements, all right? Or have some money there to take care of funeral arrangement. And that money pays out within 48 hours of your passing, compared to all the other life insurance that I talked about today. So your term, your whole life, your universal life, your index universal life, your VULs, all of these policies will not pay out within 48 hours of you passing. Only your final expense insurance does, and it's important that you know this, all right? That's why I always tell you guys that you need to have a whole life, final expense, your will, and a trust, right? So that way you have money that will pay out within 48 hours of your passing. Also, another thing that we want to talk about is the tax advantages that life insurance give you. Is that, life insurance give you what's called a tax-free death benefit, which means that any cash value and the death benefit that you have coverage for, that money will be paid out to your family tax-free. You don't have to worry about any probate or any estate tax. There's none of that attached to life insurance due to the tax code 7702 section A. All right. It also gives you what's known as tax deferred earnings, which means you do not pay taxes on the gains because it's a tax advantages. You already pay your taxes in the beginning. And then it also gives you tax-free withdrawals, and it also gives you tax-free loans. Tax-free loans mean that you can even borrow against a death benefit even after using up all the surrender value as well. That's something that most people didn't know. So the thing that you got to look at with these life insurance is that the only way you can really use it to build wealth, because a lot of people think about ways how to build wealth, and the way you can use a life insurance to do that is by simply overfunding it. You must save a lot more inside of it, so that way the money that you put in now can actually grow the money over a period of time. So the more you put it in the early years, is the more it grow in the later years. And I hope you guys understand that a lot better this time around. Another thing that I want to let you guys know as well is that life insurance gives you a lot of perks, and I want you to write these down. A lot of perks, PERCS, perks. And the perks that life insurance gives you is that, number one, it gives you what's known as protection. It gives you a lot of protection against lawsuits, garnishments, divorce, and even child support in some states as well. It also gives you a great flexibility with emergency fund. The fact that there's no 59 and a half, and you can have access to money, right? There's no stipulation on that to when you can start taking money. As long as you have surrender value in there, you could access it either through a tax-free loan or a tax-free withdrawal, depending on if you have an increasing or a level life insurance. It's also a great retirement supplement, because once again, it's tax-free money. It's tax-free money in your later years to come, because you could get tax-free withdrawals and tax-free loans. Once again, there's no RMD, and there's no 59 and a half rules. None of that applies. All right. There's none of that applies there unless you go over what's known as the MEC. And that's a whole nother thing that will show you. Most life insurance company will not let you violate your MEC anyway. They give you two options where they tell you to pay less, or they tell you to increase your face amount. Another thing about it, the perks, is that it's a great way to also, save for kids' college education, right? Because when you look at that FAFSA form and you fill it out, it doesn't require you to disclose life insurance, because life insurance is not considered an asset. Only things like your home, your 401ks, and your bank account, what's in there, these things, and even 529 affects the child's eligibility as well, if they have enough money for school. So if you save majority for a child in your life insurance, you could actually build up a great saving tool for them, and it doesn't affect their eligibility for financial aid. And another thing you must understand about this rule is that also you can get a life insurance for a child in anywhere from 8 to 14 days old, as long as they have a social security, and it takes around 8 to 14 days for social security to issue out their social security card. And as long as your child get that, they could then start qualifying for a life insurance. And a child could get half of what the parent's coverage is. So if you have $1 million plan, your child can even get up to $500,000, even as a newborn. Another thing about it is that it's a great savings tool, because once again, it gives you a lot of great opportunity to earn interest if you have the right life insurance. If I was to use an IUL, where it gives you a great growth, it gives you the great safety. So that means if you want to save and overfund your policy and save there, it gives you the earning potential of bare minimum, at least 0.75% in a market. If the market does negative for the next 10 years, you're going to be getting a positive return for the next 10 years. But if the market does very well over a period of time, and let's say that each year give you an average of, say, 20%, you will get 15% out of that as a growth potential as well. So that's why it gives you such great perks within life insurance, where it gives you protection, emergency fund, a nice retirement supplement to add on your already retirement programs, and also a great college planning for your child or grandkids, or even another great savings place, because it gives you growth, safety, tax advantages, and also what we know as protection as well for your money and for yourself. So that's the thing about life insurance, guys. It's very unique. It's a very beautiful thing when you truly understand it. And it's not just about dying. And like I said, it gives you a lot of living benefits, right? Life insurance also gives you a lot of living benefits, where you have protection in place for if you terminally get ill, or if you get chronically ill, or if you get long-term care. Some life insurance even allow you to add on long-term care as a rider inside of it. So it comes with a lot of great things. There's a life insurance now that even gives you the ability to give you a will prep. right? With a final expense insurance inside of it as well, and your regular life insurance all in one plan. So think about that. Like I said, life insurance has evolved. It's just that you got to know which one is good for you and how they work. All right. So I hope you guys learned a lot. If you have questions, you can write them in our chat room, or you could press the yes button if you'd like to ask a question. Or if you have a question, you could comment it below as well. I will definitely answer that. But just some quick announcements. So tomorrow we'll be going to be talking about annuities. And if you've been on here with annuity talks before, you know this is one of my favorite topics. And because I love annuities, I'm going to talk to you all different kind of annuities. We're going to talk about fixed annuities. We're going to talk about variable annuities. We're going to talk about fixed index annuities. All right, we're going to talk about a lot of things about annuities tomorrow. Just so you know, we have our workshops that you can have access to. You could go to our workshops every Monday through Friday. All right. So we have them at 2 p.m. Eastern time and 8 p.m. Eastern time. Every Monday through Friday, we have our workshops. And also, just so you know, our 30 by 30 financial literacy campaign, financial education isn't an option, it's a necessity. All right. Please, guys, help us to spread the word. It's a necessity. And that's why World System Builder is committed to educating and empowering 30 million families by the year 2030. Our commitment, me and my team, we've committed to 2 million by the year 2030. And we'll love to make Money Talk be one of the main driving force of that. And let's go out and empower families, right? So we also provide our financial literacy classes, just an introduction, so that way you can learn the 4 steps to financial freedom every Monday, Wednesday, Friday, Sunday at 10 a.m., 12 p.m. and 6 p.m. Eastern time, guys. And you could come in on the very same Zoom that you're using for Money Talk right now. And if you'd like to learn about how you can become an educator with us and what it's like to be a World System Builder financial literacy campaigner, do you want to come and hear us every Tuesday tonight at 7 p.m. And we also have it Saturdays at 12 p.m. Eastern time, where me and my fiance, we get to share with you guys exactly how is that work, what is that we do, and you can even hear from many of my other educators and partners about what our campaign could do for you. Extension Expo is now officially closed. Yesterday was an incredible class. We did an amazing job, and thank you everybody that supported. We saw a lot of you guys in the building, and it was so great to have you there. So remember, Money Talk is every Monday through Friday from 9 a.m. to around 9:30. And guys, we appreciate you always coming on. So remember to tell a friend to tell a friend. And always remember that you are one decision away from changing your future for the better. So always remember that the choice is always yours. So